What's an annuity? Let's talk about it on Kyle Talks Money. The term annuity refers to an insurance contract issued and distributed by financial institutions with the intention of paying out invested funds in a fixed income stream in the future. Investors invest in or purchase annuities with monthly premiums or lump sum payments. The holding institute issues a stream of payments in the future for a specified period of time or for the remainder of the person's life. Annuities are mainly used for retirement purposes and help individuals address the risk of outliving their savings. So how do annuities work? Annuities are designed to provide a steady cash flow for people during their retirement years and to alleviate the fears of outliving their assets. Since these assets may not be enough to sustain their standard of living, some investors may turn to an insurance company or other financial institution to purchase an annuity contract. As such, these financial products are appropriate for investors who are referred to as annuitants, who want stable, guaranteed retirement income. Because invested cash is illiquid and subject to withdrawal penalties, it's not recommended for younger individuals or for those with liquidity needs to use this financial product. An annuity goes through several phases and periods. These are called 1. The accumulation phase, which is the period of time when an annuity is being funded and before payout begins. Any money invested in the annuity grows on a tax-deferred basis during this stage. And then there's the annuation phase, which kicks in once payments commence. These financial products can be immediate or deferred. Immediate annuities are often purchased by people of any age who have received a large sum of money, such as a settlement or lottery win, and who prefer to exchange it for cash flow into the future. Deferred annuities are structured to grow on a tax-deferred basis and provide annuitants with guaranteed income that begins on a date they specify. Annuity products are regulated by the SEC and FINRA. Agents or brokers selling annuities need to hold a state-issued life insurance license and also a securities license in the case of variable annuities. These agents or brokers typically earn a commission based on the notional value of the annuity contract. But there are special considerations. Annuities usually have a surrender period. Annuitants cannot make withdrawals during this time, which may span several years, without paying a surrender charge or fee. Investors must consider their financial requirements during this period. For example, if a major event requires a significant amount of cash, such as a wedding, then it might be a good idea to evaluate whether the investor can afford to make requisite annuity payments. Contracts also have an income rider that ensures a fixed income after the annuity kicks in. There are 2 questions that investors should ask when they consider income riders. First, at what age do you need the income? Depending on the duration of the annuity, the payment terms and interest rates may vary. And second, what are the fees associated with the income rider? While there are some organizations that offer the income rider free of charge, most have fees associated with this service. Individuals who invest in annuities cannot outlive their income stream, which hedges longevity risk. So as long as the purchaser understands that they are trading a liquid lump sum for a guaranteed series of cash flows, the product is appropriate. Some purchasers hope to cash out an annuity in the future at a profit. However, this is not the intended use of the product. We'll then look at types of annuities. Annuities can be structured according to a wide array of details and factors, such as the duration of time that payments from the annuity can be guaranteed to continue. As I mentioned earlier, annuities can be created so that payments continue as long as either the annuitant or their spouse is alive. Alternatively, annuities can be structured to pay out funds for a fixed amount of time, such as 20 years, regardless of how long the annuitant lives. First, there's the immediate and deferred annuities. Annuities can begin immediately upon deposit of a lump sum, or they can be structured as deferred benefits. The immediate payment annuity begins paying immediately after the person deposits a large sum. Deferred income annuities, on the other hand, don't begin paying out after the initial investment. Instead, the client specifies an age at which they would like to begin receiving payments from the insurance company. Then there are fixed and variable annuities. Annuities can be structured generally as either fixed or variable. Fixed annuities provide regular periodic payments to the person. Variable annuities allow the owner to receive larger future payments if investments of the annuity fund do well and smaller payments if its investments do poorly, which provides for less stable cash flow than a fixed annuity but allows the annuitant to reap the benefits of strong returns for their fund's investments. While variable annuities carry some market risk and the potential to lose principal, riders and features can be added to the security contract, usually for an extra cost. This allows them to function as hybrid fixed variable annuities. Contract owners can benefit from upside portfolio potential while enjoying the protection of a guaranteed lifetime minimal withdrawal benefit if the portfolio drops in value. Other riders may be purchased to add a death benefit to the agreement or to accelerate payouts if the annuity holder is diagnosed with a terminal illness. The cost of living rider is another common rider that will adjust the annual base cash flow for inflation based on charges in the Consumer Price Index. But there are criticisms of annuities. One criticism of annuities is that they are illiquid. Deposits in new annuity contracts are typically locked up for a period of time, known as the surrender period, where the annuity would incur a penalty if all or part of that money were touched. These periods can last anywhere from 2 to more than 10 years, depending on the particular product. Surrender fees can start out at 10% or more, and the penalty typically declines annually over the surrender period. So you must be wondering, what's the difference between annuities and life insurance? Life insurance companies and investment companies are the two primary types of financial institutions offering annuity products. For life insurance companies, annuities are a natural hedge for their insurance products. Life insurance is bought to deal with mortality risk, which is the risk of dying prematurely. Policyholders pay an annual premium to the insurance company, who will pay out a lump sum upon their death. Policyholders pay an annual premium to the insurance company, who will pay out a lump sum upon their death. If the policyholder dies prematurely, the insurer pays out the death benefit at a net loss to the company. Actuarial science and claims experience allow these insurance companies to price their policies so that an average insurance purchasers will live longer enough so that the insurer earns a profit. In many cases, the cash value inside of a permanent life insurance policies can be exchanged via 1035 exchange for an annuity product without any tax implications. Annuities, on the other hand, deal with longevity risk, or the risk of outliving one's assets. The risk to the insurer of the annuity is that the annuity holder will survive to outlive their initial investment. Annuity issuers may hedge longevity risk by selling annuities to customers with a higher risk of premature death. So who buys annuities? Annuities are appropriate financial products for individuals seeking stable guaranteed retirement income. Because the lump sum puts into the annuity is illiquid and subject to withdrawal penalties, it's not recommended for younger individuals or those with liquidity needs to use their financial product. Annuity holders cannot outlive their income stream, which hedges longevity risk. So are you planning to get an annuity, or do you have an annuity? Comment your thoughts below. And as always, take care of your money.